In this video, we're going to continue linking together the three financial statements for Apple that we've projected here over these 5 years from 2010 through 2014. And just to recap, where we left off last time, we actually had almost finished our model because we had our balance sheet here, and even though it was not quite complete, you see that actually our balance check was working fine and both sides actually balanced. So really the two main missing things that we need to add in now are, first off, that the interest income and interest expense are not working properly. In fact, they're not even working at all because nothing is listed there right now. So that's one problem. And then another problem is that right now we have nothing listed for amortization of intangibles down here. So we've projected depreciation and amortization of plants, property, and equipment, but what we also need to look at is amortization of intangible assets right here. So that's what we're going to focus on in this video. And just to start this discussion, you remember from before that with PP&E and with depreciation and capital expenditures, you could create something called a PP&E schedule. And you might split out the company's assets by land, buildings, factories, equipment, and so on and so forth. And that would be one way that you could split that out. Then you'd look at how much they invest in each of them, and then you'd look at the depreciation from each of them over the course of 5 years or 10 years or however long it takes. Well, similarly, you could also do something like that for intangible assets. So I'll just call this intangible assets schedule. And you could split it out into intangible asset number 1, and then number 2, and then number 3, and keep going on like that, and add in however many additions the company has made, and also the amortization of each of them. So how much value is each one losing over the course of these 5 years or 10 years or whatever our period is. But the truth is, you don't really do this too often in investment banking. It's much more common to see a PP&E schedule and some sense of capital expenditures and depreciation by different asset classes, as opposed to seeing an intangible asset schedule and an amortization schedule like this. The reason is because usually a company's intangible assets are very difficult for you to know anything about. There's usually very limited information in the filings, and also because unlike depreciation, for example, and capital expenditures, a company often breaks out its amortization of intangibles, and it actually tells you exactly how much it expects to amortize each year over the next 5 or 10 years. So to get these numbers, our approach will be to go back to Apple's 10K, their amended 10K right here, and what you should do is press Control F in your web browser and then do a search for amortization. You have to press enter a couple times to skip down to the part that we want. You see that it's listed in a couple other places here. We're not interested in any of this. We want to see an actual schedule of their anticipated amortization expense over the next 5 years. Okay, and here we go. So it's actually under Note 6 in their 10K. So if you want, you're following along, you can actually just do a search for Note 6 as well and come down here to Goodwill and other intangible assets. And you see that they've broken out the assets here and then the accumulated amortization. What we want is this amortization schedule here at the bottom for 2010 through 2014 and thereafter. So we're not going to bother doing extra work here. Apple has already made the projections for us, and so we're just going to go in and use their numbers directly from here. So let's go back to our schedule right now. So we'll enter 40 for 2010, 37 for 2011, 28 for 2012, and then 13 and 10 for 2013 and 2014. And so that's what our amortization of intangibles will look like. Again, the reason we're doing this is because Apple has already given us the numbers in their filings. We don't even have to look in equity research or other sources. We can just pull these numbers directly from their filings, and that's often the easiest thing to do when you're dealing with projecting amortization of intangibles in a standalone operating model like we have here. So now let's just check the rest and make sure that it flows through correctly. So, okay, we see that it's actually not working correctly here. So what we need to do here for amortization of intangibles is we need to link it up to our schedule above, which I'll do right now. Then I'll press Control C and then highlight this whole area and then Alt ESF to paste the formula. let's just check the operating income formula. So we're properly subtracting amortization and depreciation here and everything else. So it looks like that's working correctly. Now on the balance sheet, for other intangible assets, so it looks like this is now decreasing, which is correct. In Excel, I'm just going to highlight these and tell it to ignore this inconsistent formula error. Now on the cash flow statement, we see that amortization of intangibles is being reflected properly here. So to summarize how this works, amortization of intangibles will show up on the income statement and will hit your operating income right here. On the cash flow statement, they are a non-cash expense, so you add them back right here. And then they show up on the balance sheet because you subtract them from your intangible asset amount on the asset side. You add in any intangibles that you acquire, but usually in models, you just worry about the assumption for amortization rather than acquiring new assets like this. So that is how they flow through. And then as a final check, you can see that our model here still balances, so it looks like we're still fine on that count as well. And so now our three statements are almost linked together. The only remaining thing to do now is to properly fill out the interest income, expense, and then other income and expense right here, which is coming up in the next video in this course.